Howdy, folks. Let's talk about money, honey. Down here in the South, we love our sweet tea, our front porch swings, and taking care of our finances. Now, saving and investing might sound as exciting as watching paint dry, but trust me on this one. It's the secret sauce to a life where you're calling the shots, not your bills. Think of it like this. Saving and investing are your financial freedom fighters. They're the dynamic duo that helps you build a future where you can retire comfortably, send your kids to college, or finally take that dream vacation to the beach. Ready to build yourself a brighter financial future? Let's dive in. Imagine this. You're sitting on your porch swing, a glass of iced tea in hand, watching your grandkids play in the yard. You're not worried about bills because you have a nice nest egg tucked away. That's the power of saving and investing. Saving is like putting money aside for a rainy day. You're building a safety net for emergencies or unexpected expenses. Investing is like planting a seed and watching it grow. You're putting your money to work in things that have the potential to increase in value over time. It's all about making a plan and sticking to it. The key is to find what works best for you and your financial goals. Let's face it, worrying about money is no fun. It keeps you up at night, stresses you out, and can put a strain on your relationships. But it doesn't have to be that way. By understanding how to save and invest wisely, you can take control of your finances and gain peace of mind. Think of this guide as your personal finance toolkit. We'll equip you with the knowledge and strategies you need to make informed decisions about your money. So, grab yourself a glass of sweet tea, find a comfy spot on the porch swing, and let's get started on the path to financial freedom. Let's kick things off with the basics, savings accounts. Think of a savings account like that trusty mason jar. It's a safe and secure place to stash your cash. You deposit your money, and you earn interest. Interest is a bonus for letting the bank borrow your money. Rates are low, but your money is federally insured. You can easily access your money whenever you need it. Section 2, Time is Money, Certificates of Deposit, CDs. Looking to earn more interest on your savings? Consider a certificate of deposit or CD. Think of a CD like baking a pie. You commit your money for a set time and the reward is a sweeter return. In exchange, the bank offers a higher interest rate than a regular savings account. But you can't touch your money during the term, or you'll face a penalty. CDs are great if you won't need the money for a while and want a higher return. Section 3, the best of both worlds money market accounts. Now, let's talk about a hybrid option, the money market account, or MMA for short. Think of an MMA like a good cast iron skillet, versatile, reliable, and always up for the task. It's like a cross between a savings account and a checking account, offering a bit of both worlds. Like a savings account, an MMA earns you interest, and the rates are usually higher than what you'd get with a traditional savings account. Plus, you have the flexibility to withdraw your money, usually with a limited number of transactions per month. MMAs are a good option if you want to earn a decent return on your savings, but still need access to your cash for unexpected expenses or opportunities. They offer a good balance between liquidity and growth, making them a solid choice for folks who want the best of both worlds. Section 1. Taking stock investing in companies. Now that we've got a handle on the basics of saving, let's move on to the exciting world of investing. Investing is like planting a pecan tree in your backyard. It takes time, patience, and a little bit of know-how, but with the right care, it can grow into something big and strong, providing for you for years to come. One of the most common ways to invest is by buying stocks. Think of stocks like owning a tiny piece of a big old company like Apple or Coca-Cola. When you buy stock, you're buying a small ownership stake in that company. And just like a proud pecan tree owner, you get to share in the company's successes and, well, sometimes its failures too. Now, the value of your stock can go up or down depending on how well the company is doing. Section 2, the long and short of it, understanding stocks. Now, there are two main ways to make money from stocks: dividends and capital appreciation. Dividends are like getting a little bonus from the company just for being a shareholder. It's their way of saying thank you for investing in their success. Capital appreciation, on the other hand, is when the value of your stock goes up over time. That's why it's important to do your research, diversify your portfolio, don't put all your eggs in one basket, and be prepared to ride out any market fluctuations. Section 3, Bonds, lending a helping hand for profit. Now, if you're looking for a slightly less risky investment option, let's talk about bonds. Think of bonds like lending money to your neighbor down the street. You're giving them a loan, and in return, they promise to pay you back with interest. But instead of lending money to your neighbor, you're lending it to a company or government entity. Bonds are considered less risky than stocks because they tend to be less volatile. Section 4, Finding the right balance, stocks and bonds together. Now you might be wondering, Renee, should I invest in stocks or bonds? And the answer, my friend, depends on your individual financial goals, risk tolerance, and time horizon. If you're young and have a long time horizon until you need the money, you might be more comfortable taking on more risk. In that case, stocks might be a good option for you. But if you're closer to retirement and need a more stable investment, bonds might be a better fit. Many investors choose to diversify their portfolios by investing in a mix of stocks and bonds. Now, let's say you're ready to invest in stocks and bonds, but you don't want to spend all your time researching individual companies or bonds. That's where mutual funds come in handy. Think of a mutual fund like a big old potluck dinner. Everybody brings their favorite dish, in this case their money, and it all gets pooled together to create a delicious spread. With a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds are managed by professional money managers who use their expertise to pick the investments and try to make the fund grow over time. It's like having a personal chef at the potluck who knows exactly which ingredients to combine to create a winning recipe. Now, if you like the idea of mutual funds but prefer a little more flexibility, you might want to consider exchange-traded funds, or ETFs for short. ETFs are like the grab-and-go version of mutual funds. They offer similar diversification benefits but are traded on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the trading day, giving you more control over your investments. ETFs also tend to have lower fees than mutual funds, which means more money stays in your pocket. And just like mutual funds, ETFs offer a wide range of investment options, from broad market indexes to specific sectors like technology or healthcare. Both mutual funds and ETFs offer a number of advantages for investors, especially those who are new to the game or don't have a lot of time to dedicate to managing their investments. They provide instant diversification, professional management, and a low barrier to entry. You don't need a lot of money to get started, making them accessible to investors of all levels. However, it's important to remember that mutual funds and ETFs are still investments, and investments come with risks. The value of your investment can go down, and there's no guarantee of a profit. It's essential to do your research, understand the fund's investment objectives and fees, and make sure it aligns with your overall investment strategy. Section 4, the importance of a long-term perspective. Investing, whether in individual stocks, bonds, mutual funds, or ETFs, is a long-term game. It's not about getting rich quick, but rather about building wealth gradually over time. Think of it like nurturing that pecan tree in your backyard. Similarly, with investing, you need to stay the course, ride out any market ups and downs, and keep your eyes on the prize, a secure and comfortable financial future. Remember, the stock market has historically trended upwards over the long term, and by staying invested, you give yourself the best chance to reap the rewards. Section 1. Going against the grain alternative investments. Now, folks, we've covered the bread and butter of saving and investing savings accounts, CDs, money market accounts, stocks, bonds, mutual funds, and ETFs. But just like a good Southern meal wouldn't be complete without a side of collard greens or a slice of sweet potato pie, sometimes you gotta spice things up with some alternative investments. These are investments that fall outside the traditional categories we've discussed so far. They can add a little flavor to your portfolio, but they also come with their own set of risks and rewards. Think of alternative investments like adding a dash of hot sauce to your grits. A little goes a long way, and it's not for everyone. Section 2, Bricks and Mortar, investing in real estate. Real estate is a popular alternative investment. Down here in the South, we know a thing or two about land and property. It's tangible, valuable, and can build wealth over time. You're buying property with the hope it increases in value. You can also generate income from rentals, but it's not for the faint of heart. It requires capital, can be illiquid, and comes with risks. But for those who invest wisely, it can be rewarding. Another alternative investment that often piques people's interest is precious metals. Gold, silver, platinum. These shiny, sparkly things have been a store of value for centuries. People invest in precious metals for a variety of reasons, including hedging against inflation, diversifying their portfolios, and simply because they like the idea of owning something tangible and enduring. Think of precious metals like that heirloom silver tea set your grandmother passed down to you. It's beautiful, it's valuable, and it holds sentimental value. However, just like real estate, investing in precious metals is not without its risks. The prices of precious metals can be volatile, they don't generate any income, and their value is largely tied to market sentiment and economic conditions. So, before you go sinking your hard-earned money into a safe full of gold bullion, make sure you understand the risks and rewards and consult with a financial advisor to see if it's the right investment for you. Section 4. Proceeding with caution. Alternative investments and you. Now, I'm not saying you should run out and pour all your money into real estate or precious metals. These alternative investments can be complex, risky, and may not be suitable for everyone. But I do want to encourage you to keep an open mind, do your research, and explore all your options. The key is to create a well-diversified portfolio that aligns with your financial goals, risk tolerance, and time horizon. And remember, folks, if it sounds too good to be true, it probably is. Don't be afraid to ask questions, seek professional advice, and invest wisely. After all, it's your hard-earned money, and you want to make sure it's working as hard for you as you work for it. Well, folks, we've covered a whole lot of ground today, from the safety and security of savings accounts to the potential risks and rewards of alternative investments. It's been a whirlwind tour of the financial world, but I hope you've come away with a better understanding of how to make your money work as hard for you as you do for it. Remember that old Southern saying, you can't make a good pecan pie without cracking a few eggs? Well, the same goes for building a solid financial future. It takes a little effort, a little planning, and maybe a little bit of risk-taking, but the rewards are well worth it. Think back to that picture we painted at the beginning of our journey. Sitting on the porch swing, iced tea in hand, watching the grandkids play with not a financial worry in the world. That's the dream, folks, and it's within your reach. Now, I know all this financial talk can seem overwhelming, but don't worry, take things one step at a time. Start by asking yourself some basic questions. What are your financial goals? How much risk are you comfortable taking? Are you a slow and steady investor or willing to gamble for higher returns? Once you understand your goals and risk tolerance, explore different savings and investment options. Remember, there's no one-size-fits-all approach. Now let's talk about the importance of patience and consistency. Building wealth takes time, folks. It's not a get-rich-quick scheme, but rather a long-term commitment to making smart financial decisions day in and day out. Think of it like tending to your garden. You can't just plant a seed and expect it to bloom overnight. It takes time, care, and consistent watering to nurture it into a thriving plant. The same goes for your finances. Start by setting aside a little money each month, even if it's just a small amount. As you get raises or bonuses, increase your savings rate. Make it a habit to live below your means and avoid unnecessary debt. And remember, it's never too late to start. Whether you're in your 20s just starting out, in your 40s playing catch-up, or in your 60s nearing retirement, there are steps you can take today to improve your financial well-being. So there you have it, folks, your guide to smart savings and investments. We've covered the basics, explored different options, and talked about the importance of finding what works best for you. Now it's time to take action. Don't let fear or procrastination hold you back. Embrace your financial journey, seek out resources and support, and remember, you've got this. With a little bit of planning, a dash of common sense, and a whole lot of determination, you can achieve your financial dreams and build a brighter future for yourself and your loved ones. And hey, once you've reached your goals, don't forget to treat yourself to a big slice of sweet potato pie. You've earned it.